Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
This is Jason Buck. I'm the CIO of Mutiny Funds, and it's my pleasure to sit down today with the guys from Breakout Funds, which is an opportunistic global macro fund. I have Aaron Larkin and Matt Laviolette from Breakout Funds. Guys, I want to maybe just start with a quick bio, or even extensive bio if you want, but let's start with Aaron. Tell me a little bit about your background.
Yeah, so, I actually started off in 2003 working for a prop firm named Black Diamond Capital, which was the formal name. In Chicago. And so I actually spent the first roughly 10 years of my career working in the prop space. And I spent 3 years with the prop firm. And then I ended up leaving the prop firm and managing my own book for 7 years. And then, eventually I ended up taking over the CIO position for a small family office. So, spent my whole career, working in the prop space and then going into managing assets. And then we launched Breakout Funds in 2018. So that's kind of how the team came together. Matt can kind of introduce himself and dig in, but we both, started off working together and then, joined back up later on in our career. Great.
Matt?
Sure. Thanks for having us. Pretty similar. So I started at Black Diamond as well in I believe, January 2004. Just about 6 months behind Aaron. So I was there until 2010, and I was a partner until 2010, and left with another partner to run a macro focused book with some other guys in Chicago, and did that for about 5 years and had a good run, and then kind of rejoined with Aaron to run the family office, and then we eventually broke off and launched Breakout. So that's the 20-second version of our history. I'm sure we'll dive into to specifics on kind of how that played out.
Great. And Matt, can you give me kind of like a general overview for a prop firm for people who don't know like how it works and kind of the setup of a prop firm?
That's a good point. So prop firms and people from Chicago and the markets, very familiar with, but others are not. So that's a good point. So a prop firm would be your trading partner capital. We didn't have any outside investors. And so, the general format is you have a gamut of traders and they're allotted X amount of risk sort of per day. And, if you hit that on the downside, you're done. See you later. See you tomorrow. And, your time frame is very short. Your leverage is very high. But because you're in such a tight window, you can, live in that environment if you sort of figure it out and know what you're doing and evolve with the markets. And that's sort of the prop space. It's very similar and very different from what we're doing now. So I think it's a good training ground for where we are these days. It taught us to really roll up our sleeves and be in the price discovery every single day for a lot of years. And, I think that's a skill that a lot of, managers that come from analyst backgrounds at banks don't necessarily have. And so, we try and really, take advantage of that skill set inside of our process.
Yeah, that's why I want to kind of to highlight what a prop firm does, because it provides incredible discipline that maybe people aren't used to, where you have such tight stop losses and you eat what you kill. So it's a very unique background, and I think we'll get into how that plays out to the way you guys think with Breakout Funds. Aaron, also a quick question for you. You said for a while, was it 7 years you were managing your own money? Why did you decide to get back into the headache of running other people's money? Wasn't it better off just sitting there and managing your own?
Yeah, kind of good question. I think it was the challenge. Actually, it was the competitive nature, is you want to challenge and you want to kind of step in and do something bigger, and the strategies that I've developed and Matt developed were scalable, and that's typically a challenge that prop traders have, is making that next jump because their strategies aren't scalable. And so we saw that there was an opportunity, and introduction was made, and so that's kind of how it worked out.
Do you also think a lot of times prop traders, their strategies are not really scalable? They're capacity constrained. So you have to think a little differently if you're building to scale. Is that accurate, or would you disagree?
Yeah. No, that's definitely accurate. It's definitely accurate because you have a couple challenges. One is scalability, and second, cost preventative from actually trading and executing that. As at the prop firm, we were members of the Chicago Mercantile Exchange, and so you benefited, from execution cost that came along with that. So those are a couple inputs that go into why, managing assets at a larger scale is done slightly differently than it is at a prop space.
Got it. And when I think about like discretionary global macro, in my mind, if I were to simplify it too much, I think it is about like long-term leap options, right? A discretionary global macro trader has a general thesis and it may take 3 to 5 years to play out, and hopefully they have an asymmetric payout. But you guys look at the world very, I think, differently. You're using a very opportunistic model. You're using the future space, and you may be using a shorter to medium term time frame to express global macro trades. And you use a very systemized process of doing it, but it's also discretionary overlay. I think we talk a lot about on this podcast and at our firm is that the future is man plus machine. So if you guys kind of want to start walking through the way you kind of look at the markets, or how you take maybe a top-down view and how you combine multiple ways of looking at the market to build out your global macro strategy.
Yeah, no, definitely. So when Matt and I came together, and as I mentioned, we worked together at the prop firm for 3 years, and then Matt and I continued our conversation, all the way up until we joined back up again, and we consistently talked, throughout the day on what our thoughts were and kind of what we were expecting. And he and I both had two different approaches. And so I was kind of more of a levels trader, and Matt was a little more of a momentum trader. And so when we came together, the idea is what we wanted to blend, both of our skill sets and kind of look at, we look at markets slightly different, even though we both traded similar markets. And we had similar ideas, but the actual execution of that was different. And the execution of that actually changes the equity curve tremendously. So as we came together, the idea was, one, to blend our ideas. And then second is we ended up bringing another gentleman from, a quantitative background. And we wanted to quantify. We wanted to really dig into our views and our strategies and really try to understand what works, what doesn't work, and how does it work. And so, we did spend a lot of time in really digging into what do we do well, what do we not do well, and where can we improve. And that's kind of how we end up forming into our kind of three-prong approach into how we invest in our process. And so, as you mentioned, typically in the macro space, it's kind of looking for really long duration trade setups, and that's kind of the game plan. But the problem is you get a lot of waiting. You get a lot of waiting when you're waiting for that to come up. And so, our time horizon is, because we came from the prop space, we're used to, we want instant gratification. We want to see it now. We want to see confirmation. We want to see price discovery. And so it's really about being patient and waiting for those setups. So you're kind of blending this longer duration, style with kind of our background of really wanting those instant gratification setups and those catalysts and those price discovery. And so you kind of start at this 30,000 foot view. Here's your macro playbook, and this is kind of what, for us, our time frame that we're looking to play out is anywhere from 3 to 6 months. And that's kind of, the macro playbook is really like, this is what we envision, this is what we think is going to play out, and here's where we think the strength and weaknesses on various asset classes. And instead of us just kind of putting those trades on and sitting back and waiting, coming from our prop background, we need to eat what we kill. We need to make money regardless. We can't sit back and just patiently wait for that setup to play out. And so what we've developed is like these two other prongs that come into, actually quantifying and developing to our process. And so the first prong is our quantitative signals. And we've generated some signals. Some are mean reverting signals. Some are breakout signals. We've got a trend trading signal as well, just because we use that for kind of positioning to understand kind of where, other positions are at. But these signals are multi-duration. So some single-day signals, some 10-day signals, and some also multi-month signals. And so we're using those signals there as votes. We don't take every signal. We're actually looking for clusters of similar signals. When you get those clusters of similar signals, that's confirmation into what maybe our macro playbook is. And then the third prong that we have is, what's driving price right now? like, what does the market really care about? Is it, U.S.-China trade tensions that was typically, driving the headlines in 2019? Is it U.S. and North Korea tensions that, there was probably a month there that was really heightened, and, and typically the market was coming in risk off, on Sunday night because there was tweets that were going back and forth over the weekend. U.S.-Iran that we saw in early in 2020, was that January, February, Matt? Can't remember. It was.
Yeah, that was like the second week of January, 2020.
Yeah.
Seems like a long time ago.
Exactly. Yeah. That came in, and that could have been, as we kind of put, is like the trump card. Like that overlays what our macro viewpoint is, that trumps what our quantitative signal is, because if a war brews and breaks out in the Middle East, that's what everyone's going to care about. They're not going to care about the other stuff. And so that kind of comes into our decision. And really what we're looking for is when those three prongs align, and then that's where you're looking to execute. And so, I kind of skipped over that, the macro is a 3 to 6 month duration. So you're at a longer duration, strategy. Our quantitative signals are anywhere from 1 to 10 day signals. We use some other signals just for positioning that are longer duration. And then our current market environment is kind of like really what's happening now and what do we care about and what we're going to care about the next 10 days. And so you're looking at multi-duration, signals that come into making our final discretionary decision. And so those three inputs come into making our discretionary decision. And then when we get to our discretionary decision, we're looking for trades that are anywhere from 1 to 10 day time frame. We put those trades on in 3 increments. And then in those 3 increments, as we get price confirmation, we add to those trades. And so really what we're looking for is a catalyst. We're looking for a catalyst, a new vote that is in favor of what our macro, theme and what our quantitative signals are. So that's kind of like at a high level, kind of the process.
So talk to me a little bit about the longer term kind of, the first prong, if you're looking at kind of the world 3 to 6 months out. Are you guys using kind of a classic Harry Brown permanent portfolio 4-quadrant model, like as looking at on the axis of inflation and growth, and which asset classes are going to do well in either of those environments? Is that the first kind of step, is looking 3 to 6 months out? Where do you think the puck is moving on any of the 4-quadrant model? Is that fair?
Yeah, that's fair. That's very much an important factor of where we think, kind of where's the puck moving, and how does that, play out in various asset classes?
Yeah. One thing I'll jump in there and mention is that, and that's a great point, is we do kind of look at the world in terms of like a 4-quad model of growth and inflation. And it not only kind of matters where we're at, right now, but it matters where we're going. And, and that's sort of where the nuance comes in, because markets want to look forward and pull forward what's coming. And so, you don't know if today's the day we're going to start pricing in the next piece of the market, or is it going to be in July? We have a pretty good idea where we're going, but we don't know when, right? And we don't try and predict it. And that's something I think, we've learned over a lot of years is, just because you think something's going to happen, it doesn't necessarily mean that you're right. And more times than not, you're probably wrong. And, you let the market tell you when you're right and when you're wrong. And I think that's something that our prop skill set really ingrained in us is, it doesn't matter if you're right or wrong. The market is what it is. And you have to play the game that's in front of you. And if you don't, you're not going to be doing this. And so that's kind of one of the main reasons we dove in when we designed our process, is to get inside of this 1 to 10 day time frame, because it doesn't force us to marry an opinion. It doesn't say, oh, hey, we're bullish, equities, we're bearish, bonds here, and so we're just going to be short bonds and buy some SPOOs and see you later. Our opinion has to be something that we have with conviction in, but also there has to be a catalyst in place, and all of the items, the votes that Aaron just described, have to kind of come into line to get a position on. So we may, have an opinion that we love something, and it might take us 5 weeks to get that trade on, because it's sort of the stars got to align to get that on. And sometimes that means we'll miss a trade, and sometimes that happens, and we're fine with that. And we've learned over all this time that we're always going to miss trades, but there's always another trade, and you just kind of want to be very picky. And all of our signals that Aaron just mentioned are designed to be very picky. They're not very very active, and so some of them may trigger a cluster may occur, and that's sort of what we're looking for. But at the same time, some of them may, it may be 6 months or 9 months before they occur again. And so that's sort of all by design, to be picky. So we want to be, very aggressive when we have a cluster of opportunity and really take advantage of it. And when there's not, we want to be equally less aggressive. We want to be out of the markets. We want to be flat a lot. So if you're an investor in Breakout, what you'll see is, a lot of days, now as an example, recently we've been flat a lot, 1 to 2 positions on, at a low level of risk. But when the opportunity comes in line, we'll be very aggressive, and that'll go up quite a bit. And so you'll see that a lot of our returns are clustered as well. So inside of a year's equity curve, while the end of the year, knock on wood, has been, good since the beginning of our career. Inside of that year, the returns are always lumpy. So there's 3 to 5 chunks of returns during a year. Sometimes those are a week time frame or a few weeks time frame. Last year was a little different because of COVID nonstop there for about half the year. But those other times you really want to rein it in, as I was saying, and recognize that, hey, that the risk reward's not there, and just be ready for it and be okay with doing nothing for a while.
Yeah, it's interesting. It's almost like a combination of the lumpiness of discretionary global macro, but with the tight stops and the discipline of maybe like a CTA trend manager. So it's like it's an interesting combination there that you rarely see. But also, Matt, if you think about the 4 quadrant model and the axes of growth and inflation, it's easy to look in hindsight, like which quadrant we've been in, right? But then are you guys studying almost like rate of change to see maybe where we currently are? And sometimes you're in 2 of those quadrants, or how do you guys kind of assess that? Do you have a different way of looking at it?
What you just said is the most important thing, right? It's the rate of change. So, we're what we call the quad 2 right now. And that's sort of, growth accelerating on a sequential basis on a rate of change basis. And that doesn't mean just because, for instance, what we see on the back end of this is the bad quad, right? The quad 4. So that's going to be a major slowdown. But in our sense of, last year's quad 4 in the economic shutdown of COVID, that's, major negative growth. Whereas this time, it's not going to be that simple. It's going to be, we're comping at 0 growth last year right now. So, we could have 10% growth at some point between now and July. And on the back end of that, we might have 8% growth, which, while it's still growth, it's a slowdown relative to the previous, the last measurable number. So that's something the market's going to have to deal with. And that's a different version of being in that same quad, if you will, from a previous year or other years. So, it's just something we're going to deal with. And I think that there's a lot of opportunity as that transition happens here in the markets. Within the next, again, like I said, it could happen tomorrow, could happen in July, it could happen, we don't know. Something will trigger that, and then we'll be ready to move when that happens.
Great. And so we were talking about, as you move from the 4 quadrant model, and then the next prong you're looking at is the quant signals. Aaron, how do you guys assess the quant signals? Are you looking at, hundreds of markets? Or you only look at the markets you trade? Or are you looking at alternative data? What are you looking at for the quant signals?
It's some of the signals are market specific. So some are just equities only. Some are, we've got a VIX, looking at vol and the VIX volatility signal, which is kind of, unique. And then some of them are also looking across multiple markets. And so there's kind of a blanket, signals that are generated across, I think there's about 80 markets that are in there. And that's kind of a cluster. We want to see a cluster within that market of similar, correlated products. So the answer is yes. Some of everything actually is what the answer is.
Yeah. One thing I'd mention is that, because Aaron and I began our careers trading for lots of years, focusing in S&Ps and NASDAQ futures. And then before we sort of evolved into the macro space of all the other, the gamut out there, we do view in our eyes through the prism of equities and how they are going to react to, a set of circumstances. And that's and then we branch out to other products. So what does that mean for FX, fixed income, precious metals, energy? But that's, we view risk on, risk off in equities, and then we sort of go from there. So while you may see, a lot of our opinions may be based in equity land, the actual execution might not be, because the risk reward is better to say, hey, I've got an equity opinion here, but risk reward wise I can put, a copper trade on, for instance, or a silver trade that's sort of captures the same idea, but can bottle up risk reward profile in a way that we're more comfortable with.
Go ahead.
Part of that, is it thinking about like the S&P 500 is the most liquid market in the world? So a lot of times risk on, risk off is really, you see the signaling in the S&P 500 market versus other markets, or is that fair?
Well, S&P is a, risk on, risk off, exactly. But in the same sense, though, equities have the most psychology in them, right? And so they have the most people freaking out all the time, right? And one way or the other, the opinion changes from day to day, whereas everything else, it's sort of hard to read the body language, if you will, or the price action of what's really going on. And so in equities, you do have a lot of noise in there of some overreactions and over leverage or under leverage or whatever the case may be. And, it does create a lot of opportunity. But it also, in the same sense, reveals what the market really wants to do. If you look at it in the context of, what volatility is doing as relation to price and time. And so when you really dig in there, you can kind of read between the lines and kind of, confirm or deny what maybe your opinion is in the moment.
And Aaron, I'd cut you off. Sorry. What did you want to add to it?
Oh, no, that's okay. We kind of already covered it, so we're good.
Got it. So those are the two prongs. And then we talked about, catalyst, or what's going on in the market now. And what's interesting about a catalyst is you have your known unknowns, like whether it's, an election coming up, or you have a spontaneous and exogenous event like a war breaks out that you weren't prepared for. So I'm kind of curious of how you guys look at both sorts of catalysts, is like something on the calendar and something not on the calendar.
Well, something not on the calendar, a good example of that is January 2020, what we were talking about with that brief Iran situation. When we sort of left 2019, it was, the trade deal with China was finally done to some extent in October, and it was risk on into the end of the year. We got some, Fed clarity on what was going to be the policy going forward, and markets were, performance chasing into the end of the year. The expectation was in, Q1 and 2 of 2020, growth was going to reaccelerate. And so volatility was coming out of the market, and, basically it was a risk on situation. And for us, that's a time to hit some base hits and, build up some P&L on a smaller basis until something changes, and be nimble and be flat a lot. And so when that Iran attack in Baghdad there at the base, on a Thursday night or whatever that was at 5 p.m., that's not in the playbook of everybody playing, growth reaccelerating in 3 weeks from now. So it forces a lot of hands that, maybe were over leveraged to the long side to hedge off their risk very quickly. And, those are situations that we will attempt to take advantage of. And, it could be to capture the downside move and that's it. Or we could be using that to actually enter positions that we wanted to be a part of. But just because the risk reward wasn't there, maybe it does line up during one of those events. And, you've seen since, all the way back since September 11th, markets have been so worried with all these events. In the mid 2000s, we had that Madrid bombing, the London bombing, we had, on and on and on. And, the half-life of those events just keeps getting smaller and smaller. And, that Iran situation, well, there was a few hours there that evening where it did look like there was going to be a major conflict. But 3 hours later, it's all over. Your job as traders is just forget it even happened, because as far as market's concerned, it doesn't matter. And things don't matter until they do. And when they do, you're really going to know it. So, and that was a situation where you had to go from, one trading style to another very quickly, and just be ready to be nimble and move when you have to.
When I think about those discrete events, it's like you said, is this the trend of a new vol spike, and is this going to continue, or is it going to mean revert in your face like you've had like in a few hours time? So that's at least looking at vol space. But I guess in your situation, it's whipsawed and getting stopped out is kind of like the worst case scenario on those, right?
Yeah, well, I mean, I'll just, one of our worst case for us that we've seen so far is during the China trade negotiation, and as I was mentioning, in October 3rd or something of 2019, there was a tweet again during the evening, same as this Iran we were just talking about, came out, said China's vice premier was going to go home and he's not going to meet Trump the next day, and so the deal's over, forget it. Markets are down 2% very quickly in evening futures. And, we were short. We caught that move and added to our positions as our process, lays out. But, a few hours later, there's an obscure tweet from some random reporter that said, they're going to stay. And so markets repriced right back up and you're left scrambling to get out of everything. And so, you just get out and that's sort of the, when markets move quickly and sharply in one direction and then, they change. That's when you're just wrong, you're wrong. You just got to get out.
And that's part of trying to capture trends, right? Is that whipsaw or stop loss is basically analogous to your theta bleed in an options trading strategy. So it's part of the process. Aaron, I'm curious, let's use a specific example, right? We go into this, let's call it a contentious election in 2020, right? But what I thought was fascinating is just kind of the recency bias, right? Because a lot of people were surprised by the original Trump election. It felt like volatility was skewing higher going into 2020 election, just because it was more like they had egg on their face for missing, the previous 4 years prior election. So I'm curious, when you're going into the 2020 election, this might help for us to think about, how you guys are looking at your signals, but then also how you're then positioning on a discretionary basis when, the election can go either way. You can see a blue sweep, you can see Trump getting reelected. How are you guys assessing that scenario in real time?
Yeah, so actually leading into the election or leading into an event that we think has potential for moving the market, one direction or other, we'll get flat. And so we'll just get flat and then we'll wait for the event, wait for the news, and then position afterwards. And so, typically that's where the discussion between Matt and I take place is we kind of dive in and say, what's the potential scenarios? And with these potential scenarios, what are we looking to happen? And here's kind of the decision tree. And then from there, you're looking for price confirmation to go along with it. And so, that's really, kind of how that's actually executed. And then there's also that scenario of, basically this is a dud and it's nothing, because to the point of everyone's expecting high amount of volatility and expecting something to happen, typically it's already played out. And so there's not really as much to do and there's not a lot of outcome from it. So that was kind of 2020. It was a toss up. Like it was a lot of unknown and it was a toss up and it was kind of really a lot of waiting. Not only did, the president, then we were waiting for the Senate to be decided whether it's, red or blue. And that was, in our eyes for 2020 specifically, there was maybe some tax harvesting that could have taken place. If it was a blue sweep, that could have added some potential volatility into the market. But we actually didn't get an answer to that until 2021. So that scenario actually didn't even play out because you're already into the new year. So, you kind of got to walk through all the scenarios and really come up with a game plan. And then from there, we're looking at price confirmation, and it's kind of walking through, okay, are we seeing price confirmation? Can we get on the trades that we're looking to get on? And then we typically have a list of priority of trades that we think has the best risk reward and the most potential. And typically the most potential is a lot of time is, where do we think the most pain is? Where is everyone positioned and that they'll have to unwind those position? And that's really where, what we look say is the most opportunity. And so that's kind of the decision tree and the process on looking to where actually execute the trade at.
When you're going down through that decision tree and all of your signals are starting to align, and then you're just waiting for price confirmation, is in essence just preparing yourself for the trade? And then once that price signal confirms it, then you're just in the trade. So you're almost always doing a pre-mortem and getting ready for that trade at all times.
Yeah, definitely. And that kind of gets into, as we would say, the art a little bit of like actually executing and putting the trade on. Matt and I both have been trading and actually executing trades for like 18 years now. And so, there's an art of how we use to enter trades that's just not done on the mathematical, standpoint of here's the entry, here's the math, the math behind it. It's kind of, we're looking at correlation between products, we're looking for price confirmation, and we're looking at, price action and levels to get that trade on. Because one element that we do, and this comes from our prop space, is we want to get, the best risk reward position on, which means the largest position with the tightest stop. And therefore we have the upside potential in the trade versus a small position with a large stop. And so that's really a piece that I think that we do different than most other firms out there, is that coming from our prop background, that's a skill set that we use, and a skill set that has, helped us, generate returns, over our career. And so we do bring that into, the asset management side as well.
Yeah. And before we get into trade construction, because I do find it fascinating the way you guys set it up, Matt, talk to me about, like, are there scenarios where all your signals are lining up, right? But like you guys said, you have a discretionary overlay. Is there any times when you guys are looking at that discretionary overlay and saying, we're not going to get in this trade, even though all the signals are lining up?
Sure. Plenty of times, more times than not, to be honest. If there's events coming on the horizon, there's a jobs number last Friday when the markets are closed, things like that coming where we know that, hey, people aren't really executing right now, and then we need to wait and see what's going to happen here. Or the election, as you just mentioned, came, you just don't want to be putting something on, even though your stuff says, hey, this is a great trade. And, you may think that, hey, this is this fits in with our viewpoint and everything lines up, risk reward's great, but it's just not going to work right now because of XYZ. And, you always have to be playing it out. And I was just thinking, as you guys were talking, the decision tree is always what you're thinking about of if something happens right now, what is the market going to interpret it as? It's not necessarily as, for instance, a jobs number. And, for the last 10 years, a lot of the times good is bad and bad is good, right? On the number front, and how our market's going to trade off that. And so that's sort of, with the election, there was a 6-pronged outcome of what could have happened. And all of it sort of led to bullish events, unless there was a major blue sweep, which we sort of even didn't get after January, but almost. If it would have gone 50-50 Senate on election night, and it was sure Biden was in there, and it wasn't the chaos, I think that probably the next few days would have been a little more chaotic, but then I think the outcome in the end, we would still be where we are now. And maybe the trading event would have been better, but the ensuing time period would have sort of played out the same.
And then Aaron, because you already hinted at it, before we get into actual like position sizing and stops and all those interesting pieces, is how do you think about the trade construction, right? If you have a basket of trades that you can put on, I mean, you're looking at maybe market indices, maybe you're looking at the energy space or metal space, and you have a lot of different instruments you can put on. Like you said, you're looking for the largest trade with the smallest stop loss. So how do you kind of run through those systems of putting on a directional trade, knowing you have a lot of instruments to choose from?
Yeah, no, it's really is kind of digging into saying, where are we at in price, where are we at in the range, and where's positioning and where's positioning, which gives us, we want we want price confirmation immediately. I mean, the one thing that about us is that when we do put on a trade, we expect price confirmation to happen within that day. And if it doesn't happen within that day, we're happy to exit it and sit back and wait for another setup. Because in our eyes, if you're not getting that price confirmation immediately, then we're missing something, or the market's already has this priced in, or there's something wrong. And so, that's kind of the process is that sometimes there'll be a lot of small trades that get put out there and maybe in some small, markets, but whatever one gives us the price confirmation is typically where the attention is going to go. And then that's where, where the attention goes. And then, you might exit the other trades or you might not just, never even got them on because, there's typically a leader. There's typically a leader in price, and that's typically the one that you're going to be involved in. And if you miss that one, then you're looking for another correlated product that's similar that maybe is lagging, and then you'll hop on board on that trade. So there's a little bit of an art, but it's, for us, the way that we kind of manage it is that we're looking, as if every position gets stopped out to a loss. And so we're not looking for those correlations to help balance our portfolio. It's the assumption is that every position is wrong and gets stopped out. And that's part of our risk management. And so,
So thinking about just some examples of maybe a leading price indicator and then a lagging one, would that be like gold is a leader and then you have a lagging with silver, or Qs are a leader and then you have a lagging with S&P? Like, how do you kind of structure those trades? The price action confirms whichever is leading, and then after maybe that price action's run out, you're looking for the laggard to kind of catch up to pricing, or how do you look at it?
Yeah, some of that all comes into the decision. It's a little interesting right now, just with all the rotation that's taking place, where markets are kind of acting independently, and you're not necessarily getting that confirmation that you're used to getting. But traditional times, you are looking for a currency to confirm the move that's taking place, and maybe one of your other assets that you're allocating in, or you're looking for another correlated product that's at least moving in the direction. You don't want to see them both. One making a major move and the other one just sitting there. You should get some correlation, confirmation across the board. If not, then typically I would say it's I almost call it a false move, but the move's probably already played out and you're going to get mean reversion. So that's kind of managing the trade after you're already in it. It's kind of managing and looking for confirmation. And that's where a lot of time is spent, is literally looking for confirmation that this trade is holding strong, in both in price and time. And that's, it's kind of understanding that piece.
So Matt, tell me about like you guys put that initial position on, but almost like you guys tranche like legging into the trade. So how kind of does that setup work?
Yeah, so we're not gonna when we go into something, what we do, as Aaron was saying, we expect markets to move right now, today, and if they're not moving, we're out, and we'll put it on again the next day or a couple days later when we think the catalyst relines up, or use that as information as like, hey, maybe you're wrong. Being wrong is awesome, because you can have the best trades ever, or when you have a whole legal pad of reasons why something's going to play out, and the market just looks at you like, hey man, it's not going to happen, and the market's generally going to go the other way pretty hard, pretty fast, and so that's a great opportunity. But we do put on our positions in 3 tranches. And so think price is moving in our direction, we'll add, our first position, depending on the risk reward of the market, is going to be 25 to 40 bips of risk. And as markets move, we'll define a couple places to add. And so we'll add up to 3 times. So another 25 to 40 bips, taking it to around 1% of our risk per trade. And so, we do run a concentrated book in that, maximum positions you'll see with us is 5 to 7 positions. But even with that, inside of that, really, there's probably 2 core positions. And as Aaron was saying, that we don't believe in, portfolio, risk mitigation. We think everything is probably highly correlated because their ideas lie in the same fundamental beliefs. So if one's going to get stopped out, we're probably going to be exiting everything, even though other markets haven't been stopped out, and we'll sort of reassess from there. But we add 3 times, take it up to around 1%, and we add to winners, we don't add to losers, and that's why we're still here.
When you think about those 3 times, is that also an aggregate? Like, say if you had gold and silver positions on, is it the aggregate position in that sector, or is it individual position?
Individual position. So we would view it. Yeah. I mean, at that point, we would be viewing that, hey, this is sort of a very highly correlated position. And so adding another tranche might be taking it, a little bit higher risk than we're comfortable with in that position or that sector. So, or that asset class. And but we do view everything as separate, because at the end of the day, prices move on their own until risk becomes one when volatility spikes, of course, and then you're sort of, all putting the same position on. But in a market like this, what we've seen recently with relatively, something we've been talking about since last summer was, as we exited the lockdowns, was what we're going to look at on the back end of this is a world where volatility is going to be heightened relative to where it has been in the past. So the floor, which is to say the floor of volatility, is just way higher than what it was ever before. So we're in other years when we've been pinned to all-time highs as we are now, vol VIX might have been at 11 or 12 or 9. We saw those were fun times. But now the floor is, we're just below 18 for the first time in a year and a half now, maybe. And so that's it's a really high level, and markets are sort of trying to digest that. And either this is going to be a springboard to higher volatility, or it's going to contract quite a bit from here. And I guess my personal opinion is that vol is going to stay high, but risk can still run quite a bit along with that. But we'll see.
It's interesting to me that, like you said, you guys are managing via stop loss. So therefore you just assume correlations are going to 1, but you don't even revert back to even the 4 quadrant model. Let's say if you had 5 to 7 positions on, like say if you were long S&P, but long gold, you're not thinking about those kind of canceling each other out in a way. You're just taking correlations go to 1 across your whole book. And that's what the assumption always is.
Yeah, it's a P&L based decision. So it's, if we're not going to be reliant because, hey, our S&P stop we're in a spot where we wanted to get out of S&Ps, but gold's working and offsetting that, we still get out. We're not using that as an offsetting. If one product's not working, it's just not working, and why would we stay in it? So we get out of them relatively quickly.
Yeah, that's interesting. Do not look at the correlations, just look at the individual trades. If it's not working, then you just get out. And so, Aaron, I was thinking about also, how do you think about the stop losses, or if you're triggering, multiple stop losses over, a day, a week, a month, how are you adjusting the overall portfolio construction?
Well, I still think we're sticking to the process. I mean, that's kind of part of it is, with our strategy and with the tighter stops, you are going to get stopped out more. I mean, that's the nature, is that stops are going to hit, and that's part of it. But it gets into kind of the positive skew, is that you accumulate small losers. But when you actually do capture a move, it pays multiple. Our kind of minimum risk reward is like a 3 to 1. And typically we're looking for much greater than that. And so one winner makes up, typically 3 to 5 losers. And so that's kind of the way the model is written, and the way that we're looking at it.
Reducing position size in a drawdown, if you guys are down 2.5% or 5%, how are you reducing position size but still staying in the game? As we like to say, surviving is thriving. Yeah.
So, at the 2.5%, we reduce by 50%, and at 5%, we reduce by 50% again. And that's kind of what we learned just from our career from day one in the prop space. And that's kind of, be disciplined, stick to that process. Because markets go through periods of time where an approach doesn't work and they get choppy, and necessarily our approach maybe doesn't work and markets get choppy. And so you do get chopped up, and that's part of it. And, as frustrating as it is, which it is as a trader, it's extremely frustrating. But there's always, it always makes a shift. And typically when it does make that shift is when the best opportunity takes place. And that's typically where, a lot of return, historically for us, a lot of our returns have been generated. And so when that shift takes place, you're still involved in the trade, and you're in there, and then as you come out of your drawdown, your sizing comes right back up, and that's typically that's how it's worked for us over our career. Drawdowns happen; they've happened multiple times, and they'll happen multiple times again in the future. So.
But even when you have those systematic ways of managing risk, it's actually, when it goes against you and you hit your stops and everything, that's kind of easier way to get out. What's actually more difficult is when the trade is running in your direction, right? And so then what are the monetization heuristics? How do you assess the trade when it's going in your favor? Those are a little bit more nebulous than just hitting your stop. So how do you assess that?
Yeah. So, in general, we're still sticking to our process of that 1 to 10 days. And so what you'll find a lot of times with us is that, I kind of think of 2019 as a good example. We were long bullish gold Q4 of 2018, and really all the way up until almost Q3 of 2021 that we were super bullish gold. And we were sitting in a long, gold trade for pockets of time. And so what typically happens is the market runs in our favor. We're sizing up initially on the move. But what happens is as the market is moving in your favor, the risk reward is changing. It's the market has made its move. Now all of a sudden the risk reward's not quite what it used to be. And so then at that point we were reducing, and taking some profits. And sometimes we might even get flat and just turn around and wait for another setup. And that's, that's part of it. Typically, there's some mean reversion and sideways movement that happens. And so we're waiting for some market structure and waiting for another catalyst before re-entering that trade. Even though that we're still super bullish at the same time. And that's,
and so,
it's kind of,
Matt, Aaron referenced this 7 to 10 day trading time frame. So is there ever like a time stop of 10 days, or you're just reassessing if you think the trade is stale or hasn't gone anywhere in 10 days, then it's time to reassess?
What we've found with the way we approach our process is, inside of that 1 to 10 days. And if we're holding beyond that, you're sort of just at the whim of randomness. It doesn't make any sense to go beyond that. So what, even we find is that 1 to 3 days is really the sweet spot. You kind of see the easiest money is made in that first 3 days, unless there's, extenuating circumstances or some other reason that capital would have to flow and really make dynamic changes, in the course of something might play out over 10 days. But like Aaron was just saying, it's all about the risk reward. And for instance, when we were buying precious metals all of, 19 and 20, it was, would have been great to just buy call options and say, see you later. But, putting that position on as it's working, and we're getting more and more convicted in our views and everything else is lining up all the way along the line. It still doesn't, when the risk reward no longer is as attractive as it was when you put it on, you've got to take it off. You just have to. And then, be okay if you miss the next little bit of a leg, but it's going to reset up and, wait a couple of weeks, or it might be a day or a couple of weeks or a month, and we'll get it back on, and that's fine. But you've got to stick if we stick to our process, which means, a clearly defined risk reward, which is the most important, and a stop that we are comfortable with. That's a spot where we're going to, look to take advantage of. But sticking inside that 1 to 10 day time frame is very important for the way we do it.
So, for example, yeah, go ahead.
Can I jump in? Sorry, I want to make a point here, and this is something that we like to point out, especially in most of our meetings, is that 1 to 10 day time frame is by design. That was quantified, and we dug into that. And the reasoning is if you look let's go pre 2019 or pre 2020. We had, as we were kind of discussing about volatility being so low, and there wasn't necessarily a lot of opportunity, and so a lot of strategies struggled during that time frame because they're looking for longer duration trades, and markets just didn't do it. And what would happen is you get a lot of these short-term signals that start an initial move and then they fizzle out and nothing happens. And so, as I always say, is that we're really looking to capitalize on the part of the move has the most momentum. And what can take place with that is that you get these, as I call them, false positives, meaning you get some catalyst, you get some strength that lasts 1, 2, maybe even 3 days. And then it mean reverts and gets back into the channel and nothing really happens. And so for us is that we want to capitalize on that 1, 2, 3 days, harvest gains, and sit back and wait for another setup. And I think that's coming from the prop space of you need to make money regardless. And so you need to be involved and be able to make money. And I would say, in general, that strategy works really well. And that's how, we're still in this game, in this business, at this point in time. And there's always pockets of times where maybe sitting in that trade and just sitting back and watching is a better approach. And that, we'll say that happens once every 10 years or something along those lines. But the other 9 years is, we're looking to try to make money consistently over time. And so that's really why that design came in, is that was a conscious decision making that 1 to 10 day time frame.
That's interesting, Aaron. So if you're thinking about, over a year or two, if all your setups are saying long gold, but you have all these time frames and you're waiting for your setups, does that mean you may be long gold at 20 different occasions throughout a year, just monetizing, waiting for the right setup, monetizing, waiting for the right setup?
Yeah.
That's structure.
And that's actually exactly what happened in 2019. Was in the precious metals, and so there was a couple of reasons why more risk was allocated to precious metals. In gold specifically in 2019, was as we kind of mentioned that we like trading equities, and equities is kind of our space filler. When we're waiting for better setups, with the tweets that were taking place, we actually reduced risk to equities and reallocated that into our precious metal, gold specific position. And so we had that position on, I would say full position 6 or 7 times throughout 2019. And then we were flat a lot as well. And by design, we like to be flat because of those headlines or those unexpected risks. Like, we want to be flat and be able to capitalize versus spending our time liquidating during those periods of time. So that's kind of part of by design as well, is that we want to express our opinions when there's the most momentum and there's a catalyst behind it. And if there's not a momentum and a catalyst, or that catalyst is stale, we want to be flat and just turn around and wait again. And so it's always in the back of our head, hey, we want to be, long gold. We think there's a lot of potential here. But let's sit back and wait until there's a new catalyst or new information that's confirming price movement.
Got it. And Matt, my last question, that's probably one you guys get often, is how do you guys deal with like the 2-star problem, right? How do you guys argue? How do you guys figure out, who's right discretionarily? And I guess one could say that every marriage is a 2-star problem at the end of the day. So maybe you have experience with both your personal marriages and then being married to each other. Like, how do you guys argue well?
Over Slack.
Yeah, but over Slack, everything can get misinterpreted in text. You got to pick up the phone pretty quick if it's needed, right?
At the end of the day, trading wise, I do have the final call on trading one way or the other. But in general, our process is, we've developed it to where we sort of know what we're going to do. It's just a matter of style sometimes of how we're going to execute that. It's very rare that we have a differing opinion of how things may play out. It's just sort of in time frame that we always have a discussion. And we get around these transition periods where markets want to pivot one way or the other, and that's always the debate that we have constantly. Even when a market is very clearly in one quadrant or another, and trading very clearly in one or the other. You want to be able to take advantage of the shifts when they happen, and sometimes that means being early to the party and being wrong, and then just going right back to the playbook, that you didn't think you were going to be doing a week ago. So, yeah, it happens. It's a constant discussion, and one thing I found that 20 years ago, way back in our prop days. We had various guys leave. I think I hired about 100 guys, and I don't know how many made it, but the 2 are still doing it or are talking to you right now. And I think one of the keys that some of the people who quit the business or exited the business was they stopped the conversation and the debate, and they wanted to have their opinion the whole time, and that's fine. To be good at this, you have to have an opinion. You have to believe in what you think. But at the same time, you have to have the conversation all the time. And so, that's what we try and do. And at the same time, let the math prove it, in the background.
And Aaron, I'm going to set you up. Do you concur with what Matt said, or do you have a differing opinion?
No, I do. I think it really is. Typically our discussions, are not necessarily on opinion. It's more on execution. As I would say, I'm more of a levels trader, and Matt's more of a momentum trader. And so, I'm just thinking of an example last night where we were in a trade. I like the trade. And I was just kind of commenting on, the trade made a significant move. It was sitting at in my opinion, a significant level. And so I was making a comment on, I think this, and this needs to hold, to still stay in that trade. And so it wasn't that I didn't like the idea. It's just sharing, like, for my opinion, if these levels didn't hold, then I would be exiting the trade or even taking the opposite position at that time. So that's kind of where I think sometimes the input comes in, is just sometimes it's the risk management of the trade is really what that comes down to is and that was really why Matt and I came together at the beginning, was this. As a trader, I felt like I would always capture the initial move. Like, I was great at capturing, the edge and capturing that initial move. I would exit the trade, pat myself on the back, feel pretty good. And Matt, at that point we could see who we're trading with. Matt was always on the other side of the trade and taking it to the next level. And I'm like, I just left all that money on the table. And so that was really when we came together, was just, I knew what I was good at and I knew what Matt was good at. And so, let's try to take some of our expertise and focus on what we're both good at and do it, bud.
Yeah, that's an excellent example of self-awareness to be able to combine complementary strategies. So I just want to thank you guys for walking us through this, because I find it's a very unique approach where you're combining that discipline of prop trading to opportunistic global macro, and it creates a very unique firm and structure that you guys created. So just thanks for coming on the pod, and we appreciate your time.
Great. Thank you. Appreciate having us.
Thank you.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm @TaylorPearsonME, and Jason is @JasonMutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.